Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. If the idea of generating passive income every month appeals to you, then I think you'll like this video because we're going to build a $1 million portfolio that consists only of stocks that pay dividends every single month. You'll see what this strategy would look like in practice, and I'll share my thoughts on the pros and cons of investing in monthly dividend stocks given the wide range of companies that exists in this group. A lot of income investors I talk to are focused on retirement and how to replace paychecks from work with a passive income stream. After all, like Warren Buffett said, that is the key to avoid working until you die. No one wants to do that. Well, dividend stocks are one way to accomplish this goal. These companies generate more cash flow than they can reinvest back into the business, so they return some of it to shareholders in the form of a regular dividend. Dividends paid by your investments can be taken as cash and sent to your bank account, or they can be reinvested back into your holdings to compound your capital and income at a faster pace. Most stocks pay dividends every quarter, but there's a special group of companies that pay a dividend every single month of the year, and many of them have high yields anywhere from 5% to 20%. This combination of yield and regular payments every month is a pretty attractive proposition in retirement, so it's no surprise that monthly dividend stocks are quite popular, even though by our count, only 80 of these investments exist on U.S. stock exchanges. Using Simply Safe Dividends Portfolio Tracker, I built a portfolio of all 80 monthly dividend stocks, investing equally across the group. This $1 million portfolio generates nearly $80,000 of annual income, which is good for a dividend yield of nearly 8%. Going into the income calendar, you can see the main appeal of this strategy. So over the next 30 days, you can see that we're getting payouts from all 80 of these companies, and most of the payouts are falling on the 15th and 30th of the month, which is pretty nice because it kind of mimics a paycheck, a biweekly paycheck. But the real appeal is when you look at the year ahead view and see the payouts bunched up by month. Most dividend stock and fund portfolios are going to have some ups and downs, some lumps in this type of schedule here, but a portfolio consisting of only monthly dividend paying stocks is nice and smooth, averaging about $6,500 per month. You can see how those figures are produced down below here at the table of all the holdings and their projected payouts over the course of a year. So we're talking about $1 million portfolio that throws off almost $80,000 of cash every year, distributed pretty evenly across months, all without needing to sell a single share. It all sounds kind of too good to be true, right? Well, unfortunately, it is, in my opinion. There's a few big risks to this strategy of investing only in monthly dividend stocks. The first is diversification. You can see this portfolio has over 70% of its value tied up in the real estate and financial sectors. Inside of these groups, you'll find a lot of retail REITs on the real estate side and lots of business development companies and mortgage REITs in the financial sector. Both of these businesses are characterized by high leverage and high payout ratios. The energy sector also accounts for nearly 20% of the portfolio and includes mostly oil and gas explorers and producers, which are known for being pretty volatile businesses as their profits are tied to energy prices. As you might imagine, a portfolio that consists of these types of businesses has a pretty hard time maintaining a safe dividend income stream over a full cycle. If we go into this portfolio's dividend growth report, we can see the income it would have generated over the past decade. 10 years ago in 2014, this portfolio, as it's made up today, would have thrown off about $121,000 of dividends. This year, it's on pace to do about $77,000, which represents a decline of almost 7% per year. If we open up the table below to see how these figures are produced, you can see each individual holding and their dividend per share chart over the last decade. And you'll notice that most of them are kind of sloping down and to the right, showing a long decline, or there's just a lot of volatility with some of these monthly dividend stocks. When your portfolio includes so many companies that have this type of dividend growth profile, it kind of makes sense how this chart comes to be. This strategy is kind of the anti-dividend growth investing approach. Now, there's some other problems with this strategy as well. So when you look at this holdings table below, it's one of my favorite parts of our portfolio tracker because it's really powerful and really flexible too. There's several dozen column options you can choose from with data metrics ranging from dividend yield and PE ratio to dividend taxation, recession performance, growth streaks. All that good stuff is in there to make it really easy to compare different metrics across all of your holdings at once. Looking at these 80 monthly dividend stocks, sorting on market cap, I can see that there's a lot of really small companies. So right here alone, you can see a handful of stocks that have a market cap below $100 million. These are probably pretty illiquid stocks that have limited information on them, and they're very much rifle shot businesses, for better or worse. There's also on this list, if you kind of dig around a little bit, lots of foreign companies. There's other companies that trade over the counter, which means there's less available public information to research them. They can also be less liquid stocks to trade. And there's a handful of variable pairs as well, especially in the energy sector, where their dividends fluctuate with energy prices. So this all results in like a pretty noisy portfolio. And it made me wonder, what if we were to remove all those stocks and just look at kind of a cleaner version of monthly dividend stocks? So I stripped out all the super small companies, the stocks that trade over the counter, the foreign stocks, and the variable payers. And I was left with a portfolio of 28 monthly dividend stocks. I invested $1 million again, and you can see the income in this portfolio is actually higher. It's close to 100 grand, which is a dividend yield of nearly 10%. But this portfolio actually has some bigger flaws. So from a diversification standpoint, you're only exposed to 3 sectors, and the financials and real estate sectors account for over 95% of the portfolio. So it's even more concentrated compared to the portfolio that had all 80 monthly stocks. And the dividend growth of this portfolio is even a little worse. So it's declined pretty consistently 7 to 8% per year on average. And over the course of a decade, that really adds up. So you can see this portfolio's income has been cut by more than half, from about $207,000 10 years ago to on track for about $94,000 in 2024. Are there any good monthly dividend stocks, you might be wondering, after seeing these high-level portfolios? And I think there are some to choose from. So if I go down here to our holdings table, I'm going to sort by dividend safety. Now, if you're not familiar, at SimpliSafe Dividends, dividend safety has been a huge focus of ours for the nearly 10 years we've been in business. We've tracked every dividend cut that has come in during that time. There's been over 800 of them. And investors who stuck with companies that had a safe or very safe dividend safety score would have avoided over 97% of those cuts. We spend a lot of time looking at a company's fundamentals, everything from how well the dividend is covered by earnings and cash flow, to the strength of the balance sheet, how the company might perform in the next recession, how committed management has been to the dividend historically, looking at news, all sorts of assessments to come up with a dividend safety score. And this portfolio of dividend stocks, most of them are not good. You can see that over 70% of the income stream from this portfolio has stocks that are rated unsafe or very unsafe with their dividend profiles. A lot of these are mortgage REITs and kind of lower quality business development companies. But there are some that have a safe score. And in the holdings table, we can easily sort and see what those companies are. There's 4. 3 of them are retail REITs, led by Realty Income, a popular dividend aristocrat, and the biggest monthly dividend stock on the list. Realty Income's yield is about 6% today, which is a lot higher than where it had been 2 years ago. As interest rates have increased, that's hurt the performance of a lot of these REITs with higher borrowing costs, slower growth. A lot of them rely on issuing debt to buy properties, and many of them have seen their stocks revalued lower as bond yields, which have no risk to them, if you're looking at treasuries, have become a lot higher and provided some competition for REIT yields. So there's some REITs here that look like decent choices if you're a conservative income investor that really wants to own a monthly paying dividend stock. There's also close to a dozen or so companies here that have a borderline safe dividend safety score. You can see a lot of REITs on this list here, which again are going to be somewhat cyclical because they have those high payout ratios and higher leverage, which can make them more volatile during downturns. But bottom line is there are some interesting companies on this list to consider if you're really set on owning some monthly dividend stocks. But most of them are not great for long-term investors or risk-averse investors, in my opinion. Chronic dividend cutters, you can see even on this list here, just in the past year, these companies have had some pretty big dividend cuts, and that's probably going to continue given their business models. Now, looking at this, it made me kind of wonder, there's so much interest from retail investors about monthly dividend stocks. Why aren't there more companies that do this? And I think there's primarily two reasons. One, paying dividends monthly instead of quarterly incurs higher costs to do so. These companies have to pay fees to transfer agents and financial institutions when they pay dividends. And there's also other costs involved too. You have to send out a dividend notice each time a payment's declared. You have to maintain a record of all of your shareholders. All those little things can add up the more times you're processing dividends throughout the year. I think maybe more importantly, though, a lot of companies just prefer to hold on to their cash as long as they can. So instead of paying out some of a dividend every single month, it could be a little bit more attractive to hold on to that cash until the end of each quarter and pay it out at that time. It also might explain why a lot of the companies on this list are more speculative in nature, right? So if you're a small company that not many people have heard of, maybe you have high debt or some other less desirable traits about your business, paying a monthly dividend and offering a high yield, those are two pretty big selling points to a lot of retail investors who are retired and wanting regular income and a lot of it. So it could be a way to kind of lure in some of these investors who aren't really doing their diligence on the quality of the underlying business and are just buying on the yield and the payout frequency. So I think that's why the monthly dividend stocks group does have so many lower quality companies on there. It's just kind of a way to raise more capital, get more investor interest in the business for what could otherwise be an undesirable business to consider. I hope this video has given you some helpful perspectives on monthly dividend stocks. If you enjoyed it, it'd be a really big help for us if you considered liking the video and even subscribing to our channel, where we'll publish a couple of videos every month on conservative dividend investing topics, everything from analyzing stocks and funds to discussing different principles behind this great strategy. There's also no obligation, but if you're curious about your own portfolio's dividend safety, diversification, and more to stay between the guardrails, you're more than welcome to give our website, Simply Safe Dividends, a try. It's completely free to sign up, no credit card required or anything like that. And within a minute, you can import your spreadsheet of your holdings or sync up your brokerage account and have a good look at everything that matters if you're into income investing. Thanks again for watching our video, and I hope to catch you next time.